Hello everybody, welcome to Monday Morning Must Knows. My name is Merlin Rothfeld. When we started these things, I don't know, over a year ago, they said pick 3 really important things to talk about for the upcoming trading week. And we've done that consistently for over a year. But you know what? I'm in a giving mood, and I want to give more than just 3. So I'm going to give you some stuff that's happening very actionable for this week, but also for the months and potentially even years ahead. The big macro picture. So you strategic investor folks out there, get your pens ready. It's going to be a wild one today. Let's start things off with the week stuff. We're going to go to the earnings calendar. Now, there are 395 companies reporting earnings, but there really aren't any like, wow kind of names out there. But we'll start there anyway. Let's look at Monday. We have Nike and then Pinduoduo. They were supposed to report last Wednesday, but apparently they couldn't make it to the party, so maybe they'll show up on Monday. Tuesday brings us Adobe Systems and Carnival Cruise Lines. Wednesday, you've got Tencent Media, General Mills, KB Homes, and Winnebago. Thursday rounds things out with Neo, Darden Restaurants, and that's pretty much it. I don't really have anything for Friday either. Now, we talked about Jerome Powell last week and how that FOMC meeting minutes and the announcement was going to be a major factor for our markets going forward. Well, last Wednesday, we saw an initial knee-jerk reaction that ripped these markets down about 1.5%. And then all of a sudden, the markets came screaming back. And we had about 3 days in a row of just nothing but gains. And it's looking pretty darn good right now. However, Jerome Powell will be speaking this upcoming week. And there is a very important announcement. Now, you can see here on the screen that it's going to happen at the Bank of International Settlements Innovation Summit. That is Wednesday at 8 a.m. Eastern Standard Time, so that's going to be about an hour and a half before the market's open. And you're thinking, well, this could have a big impact on the financial markets. Well, not really. The reason I'm bringing this one up is we've talked about stable coins, we've talked about Bitcoin and Bitcoin ETFs, we've talked about some of the issues with cryptocurrency. We had President Biden a couple weeks ago issue an executive order, say, hey, come on, government, let's get together and protect investors, make sure that we have all the rules in place so there's no nefarious actors in this space, and make sure that crypto is covered and protected so our consumers don't get taken advantage of. And I thought that was pretty darn good. Now, why this presentation is so important, especially if you're in the crypto space, is look at the title of this thing. This one is really important. Emerging Challenges for Central Bank Governors in a Digital World. You know that the focus here is going to be on CBDCs, central bank digital currencies. We're going to have one whether you like it or not. It'll probably be a few years down the road, but it is coming. So right now is the perfect time to learn about digital assets, cryptocurrencies, and you know what? I think I know someone who's created and teaches a course for Online Trading Academy on cryptocurrencies and digital assets. That's right, we've got a great course. Of course, gratuitous plug right there. All right, now this gets a little bit better because I want to talk about the Fed's balance sheet. So we went from Jerome Powell talking about technology to let's talk about their balance sheet. Now, what is the balance sheet? The balance sheet is the amount of assets that the Fed holds. They've been buying assets for years. That's what they do to help maintain a stable economy. And I'm going to show you a chart here that's going to make you feel like Macaulay Culkin in Home Alone. Grab your cheeks and just go, what? Ready? Bring that chart full screen. Let's look at that hard left edge. That little blue squiggly line you see over there was $800 billion worth of assets on their balance sheets back in 2008. And of course, a little tiny thing called the financial crisis showed up, and boom, we jumped to over $2 trillion on the Fed's balance sheets. Now, why this was important was the Fed came in there and bought mortgage-backed securities. Mortgage-backed securities, what is that? Well, at the time, the world, especially the United States, was just going into massive defaults. We had all these liar loans and ladder loans, and people just couldn't afford what they said they could afford. So the housing market collapsed. And the Fed said, you know what? Bundle all of this trash, bundle the junk that nobody wants to buy into packages, and we'll buy it. We'll buy those mortgage-backed securities. Now, what they should have done is let a free market do what it does. And that market would have collapsed, would have been a little bit more pain, but would have come out a little bit better at the end. But no. Government wants to intervene, the Fed wants to intervene, they bought mortgage-backed securities. But wait, they kept buying because, hey, nothing happened here. We just doubled our balance sheet and there was no real bad effects. It actually did good for the economy. So what happens? The party kept on rolling. And look at that chart. It just keeps on going up and up and up. And finally somebody, right around 2015, said, hey, anybody here a Keynesian economist? When you increase your money supply this much, that's really bad. We should probably stop buying and maybe even unload some. So they started to. Right around 2017, 18, 19, you see that line drifting down, which is where it should be headed. But wait, hold my beer, here comes COVID, ba-boom! We saw a huge increase, and we are up over $8 trillion on that Fed balance sheet. Now, why is this so important? Because this is printing money and more money and more money. We've gone from 2008 to 2020, so you got, what, 14 years, we've gone from $800 billion to over $8 trillion. That's a 10x rate of return on your portfolio for the Fed. Did your portfolio go up 10x? I don't think it did. Now, why is this important? Because printing money has a very clear impact on our markets. So what is that? Take a peek at this chart, and you're probably feeling this pinch right now. It's called inflation. At the bottom, I've got Consumer Price Index, and you see CPI and core CPI. The blue line represents Consumer Price Index, which is what you and I pay for a specific basket of goods and services. The core CPI takes out food and energy. And let's be honest, nobody here is living without food and energy, so it's kind of a stupid point to include that red line. Anyway, I think you can see the parallel here where we have a massive increase in the Fed's balance sheet starting around 2020, and all of a sudden inflation has skyrocketed. We're sitting right now at about 7.9% on inflation. Now that is a pretty important thing to be thinking about going forward because inflation doesn't appear to be slowing down, and given all that's going on with Russia, Ukraine, commodities, oil, we could see much higher inflation going forward, so buckle up, it's going to be a wild ride. But wait, there's more. Let's talk about the 10-year bond. The Fed also has said at that meeting last Wednesday that they are going to start to unwind their balance sheet, and he made specific reference to at an upcoming meeting. The next FOMC meeting will be on the 4th of May, just a few weeks away, I'll call it a month and a half away. Now, why is this important? Because at this point, the Fed has trillions of dollars of bonds and treasuries and mortgage-backed securities on their balance sheet. They've been propping up a market. Now, here's how bonds work. As the demand increases for bonds, right? If everyone's trying to buy bonds, the issuer of that bond can lower the interest rate. Because if everyone's trying to buy your product and that product pays interest, you can go, well, wait a minute, I don't want to pay as much because so many people want my product. Well, the number one buyer of that 10-year for years has been the Federal Reserve. And now they've said they're going to start to sell. So let's flip this upside down now. If the Fed begins to sell that 10-year, meaning it's flooding the market with supply of 10-year bonds, what do you think the consumer is going to do? The consumer is going to go, wow, there's a flood of these things. There's so many. I don't know if I want to buy these. Or maybe I need to be incentivized to buy more. And what has to happen? Rates will go up as an enticement for people to buy these 10-years, which means what? Rising rate environment. So take a peek at this 10-year chart because it's critical to understand how this impacts our financial markets. As you can see, going back into the 1980s, it has been a very steady decline, and some of us have refinanced our homes or gotten a mortgage for 30 years that's under 3%. That's unheard of, and we just broke above 4% last week. Now that's important because that means the cost of buying a home is getting more expensive. Now let's focus on the hard right edge here. This little uptick that you see, it doesn't mean that this trend is broken. It's still in a massive downtrend since the 80s, but when we zoom in here, you can see it's been looking pretty good for about a year and a half. It's making higher lows and looking pretty clean moving forward. So this trend has already been established, and the Fed hasn't even started selling bonds yet. This is a clear indication that the market is pricing and anticipating rising yields in bonds. So keep your eye on this one going forward because this could have a massive impact on housing markets and the economy. But wait, there's more. Let's talk about the dollar. A lot of people looking at the dollar going, well, you know, the dollar is not a safe place to be during inflationary environments. That's what we hear from everybody. Let me ask you a very simple question. If you have an asset, well, let's say you have inflation at 8%. I'm rounding up 0.1% here, but let's say you have inflation at 8%. But I'm involved in some investment or holding something that's gaining, let's say, 10%. Is that a bad thing to be holding? No, because I'm beating inflation by 2%. And here's the interesting part of this. Most people feel the dollar is going to collapse, but let's look at the factors here. The factors are pointing to the dollar rallying much higher from current levels. Now, what are those variables? Well, number one is we have the Fed with over $8 trillion on their balance sheet. Where did they get that money? They literally created a digital entry on the computer and said, we need how much to buy these bonds? Another $80 billion this month? Boom, put it down. It's like a marker in Vegas, right? You got somebody who's got a ledger and they're just keeping, how much you owe us? Okay, this. How much you owe us? Okay, okay. And they have an $8 trillion ledger right now of what they owe. So as they start to unwind that balance sheet, meaning selling those assets that they've accumulated over the years, when they sell those bonds in the market, let's say they sell $20 billion a month, that $20 billion a month doesn't go back to buy something else and help the economy. It gets removed from supply So our money supply is going to start to drop, meaning fewer dollars in circulation as they retire those bonds and put the money back where they borrowed it from. So you now have a shrinking amount of supply of US dollars, and that's one tactic that the Fed can do to help slow inflation, is to remove money supply and curb spending. But what does that do for the value of the dollar? It should, in theory, push it up even more. And you can see on the hard red edge here, we've got this nice little pop over the past couple of months. So we really have to pay attention to the dollar index and to that 10-year going forward, because it could have a massive impact on our overall markets and, of course, our portfolios. Now, last week we talked about the forecasts, the expectations of what's going to happen with regards to rate increases for this year. And as of last Friday, it was a 34% chance, actually, let me take that back, as of Wednesday, before the Fed announcement last week, it was a 34% chance that we were going to see 7 rate increases by December's Fed meeting and put us at about 2% on our interest rates. After the Fed announcement last Wednesday, it spiked even higher. There are now pricing in our December meeting 8 rate increases and a 43% chance that we'll be at 2.25% in December. That is a sign that the brakes are being put on the economy, and it does not mean that we're going to crash immediately. It doesn't mean things are going to stop. It means it's going to start to slow down the machine. So as time progresses, and we'll talk about it here and our classes at Online Trading Academy, we'll be making very clear observations of what is going to be happening or what we feel could be happening based off of this type of data. The dollar index, the equity index markets, we're looking at bond markets, and this giant machine and seeing how it starts to slow down going forward. That, my friends, is a very long Monday morning must-knows. We'll see you next week.